It is not uncommon for there to be a period of overall lower volume where the market temporarily continues to immediately keep rising, following a gap up, especially a gap up candle that was bearish. It is essentially the outline of a bursting bubble. High volume when the gap forms, and high volume after, when it begins to be filled. This is also true in a gap down scenario, where the market keeps falling after a bullish gap down candle. Strong bullish sentiment emerges right at the focal point of the gap fill zone to counter the strong bearish gap fill, though this is short-lived as bearish candles and volume gradually regain the advantage in the near absence of bullish activity. It would appear a triple bottom is forming on the strong gap fill support, but it is more likely a descending triangle due to the apparent downward slope of the minor downswings. This was certainly a strong break with increased bearish volume prior to the gap down. Short-term overselling to return back to the 28 range, which is a gap down fill and prior support that was part of a recent descending triangle. The theoretical assumption was technically correct. The 28 range was influential, with strong resistance potential. However, that is not a 100% guarantee, particularly if the best case bullish scenario takes place. In this case, the best case bullish scenario did materialize to strongly and swiftly cross over the 28 range. It was clearly a strong move due to the large green candles and sustained levels of above normal volume. A great example where major short-term developments can drastically impact the long-term context on the chart. A less common scenario where a sizable reversal takes place during a low volume period, in this case from Christmas Eve to New Year's, marking the minimum parameters of a gap up. Theoretically and often in practice, the highest concentration of activity is close to the area of the closing price of the candle just before the gap up, and the opening price of the gap up candle. In this case, the gap fill level is closer to the opening price of the gap fill candle, since the real body is narrower, and the opening price is closer to the round number of 62.50. Strong 3 methods falling price action applies decisive pressure for the likely acceleration of the gap fill. The gap doesn't fill completely due to the influence of 62.50, which runs through several swing points and even a gap down fill level. Gap fill levels and ranges are often quite close to swing points in terms of their level of influence on support and resistance, so they can be used with swing points to usually identify accurate support and resistance. Here is also another example where there is relatively low volume during a period where price keeps climbing after a gap up, specifically a bearish gap up candle. Also note a triple top forms to eventually form the downtrend that moves into the gap. A compact double bottom quickly completes but faces immediate resistance due to the continued influence of the 3 methods falling price action that broke the 68.27 gap up level. Bullish activity increases at the right time to get back into the low 70s. 72.43 and 71.24 define the central gap up zone and are directly taken from the opening and closing prices of the most recent gap up candle. Incidentally, there is minor resistance in early July during 3 methods rising price action following the gap. It is mainly due to the lower boundary of the triple top. Bullish sentiment was decently strong and very consistent following the gap up, but as seen before, small gaps are often filled quite quickly, unless there is a major long-term trend. In this case, there was no major long-term uptrend and the gap up candle was bearish since it was a bearish star. The classic characteristics of relatively low volume are seen after the gap up, and this is in sharp contrast to the current large red spike. The gap up is filled, and 68.27 is in the spotlight again, though this time it is less reliable due to high volatility. Patterns and analysis techniques of all kinds are generally less reliable during periods of high volatility such as this. Major long-term support is clearly highest in the low 60s, as it and the double bottom range hold the market to finally move back into the 80s. Then, when there is the major drop in 2020, the low 60s still slow down the bearish surge. Also, the triple top in mid-2019 could also technically be called a head and shoulders, since the absolute high in the middle is slightly higher, to form the head. However, this was a very minor detail, as the resistance range was quite clear, regardless of how the pattern was classified. Though the head and right shoulder downswings would of course be useful for a downtrend line. Volatile trading to even reach the 40s, but the market reverses, and forms an inclined double bottom for a major recovery. In August, there is a less common abandoned baby doji candle to form a short-lived peak, isolated from the candles before and after it. This is worth noting since it is in the same range as a recent triple top and gap down that have completed. It could also technically be called a head and shoulders, since the middle downswing has a marginally higher high. Significant bearish context due to the convergence of multiple bearish factors leads to the development of a steady drop. After a steep decline with high volume, the market gradually shifts into a neutral to bullish range, as selling pressure is still constant but substantially decreases in intensity. This turns out to be a small declined triple bottom range. As would be expected, there is resistance to the uptrend at the neckline range around 111. That extends to the 117.50 closing price of the abandoned baby doji candle from August.